Hello everyone. Today is basically our last online session and we will learn the last chapter of the syllabus, which is chapter 14, and we will learn about financial statement analysis. So in this chapter you will learn how you can do a horizontal analysis, a vertical analysis, and especially some ratio analysis. So this is another type of performance evaluation. So when you will have your financial statements, that means when you prepare your income statement and balance sheet, you can do these types of analysis. So how could you judge your performance? There are several ways you can judge your performance. First, you could judge it from year to year, or you could compare your performance with your competitor, or you can compare your own performance with the industry average. Now you are evaluating or judging the performance of the entire company. So there are three ways to analyze your financial statement. One is called the horizontal analysis, another is called the vertical analysis, and the third one is called the ratio analysis. And for this ratio analysis, you need to know some formulas. And I actually prepared a formula sheet on your blackboard. So I would suggest please make a printout of that formula sheet and try to memorize all those formulas. But here in this slide presentation, I will go over all those formulas and I will give you some tips how you can remember all those formulas. Now let's see, what do you mean by horizontal analysis? So for horizontal analysis, you are actually comparing your performance from period to period. That means if you consider one base period and or a specific earlier period, then you can compare your performance with the earlier period's amounts. For example, here in this table you see the sales revenues, and in 2013 your sales revenue was 803,000 and in 2014 your sales revenue is 858,000. So now you can compare 2014 sales revenue to 2013 sales revenue. And how you could do it, you basically first need to find out the difference. 2014 minus 2013, this is your difference, and here we see that 2014's revenue is actually increased and it's a positive difference, and then we're going to express this difference as a percentage of 2013 sales figure. That means 55 over 803,000, which gives that 6.8 percentage. That means from 13 to 14 your sales revenue actually increased by 6.8 percentage. Now your sales revenue may decrease and you will find a negative number here, and in that case you will have a negative percentage that actually explains a decrease of your sales revenue. And this is how you actually can do your horizontal analysis. Now we will also learn some comparative income statements, and for this comparative income statement we basically express one year's numbers to another year's number, and we actually express those as a percentage of changes. So in our last slide we express everything in terms of a base period, which is 2013, and we just showed the sales revenue number. Now you can do the same thing with all other income statement numbers. So what you need to do, you need to figure out the differences for every item. So you see this is your income statement and you are figuring out the changes from 13 to 14, and then you will express all those changes in terms of your base year, which is 2013's numbers. So we just did it for the sales revenue in our previous slides, and you need to do it for every item. For example, interest expense. In 13 it was $14,000, in 14 it is $20,000. So if you take the difference, this is $6,000. You can express this $6,000 as a percentage of 2013. So that means 6,000 divided by 14,000, you will find that 42.9%. That means compared to 13, in 14 year interest expense actually increased by 42.9%. So this is how you can do a comparative income statement, and you can do a horizontal analysis. You could do the same thing for your balance sheet. So if 2013 is the starting or the base year, then you can compare every number and you can express as a percentage of 2013's number. So first you need to find out the changes, and you will see that the changes could be positive or negative. If you see a negative change, that means the numbers actually decreased. For example, you see here cash actually decreased by $3,000 from 13 to 14, and then you can express everything as a percentage of 2013's number. So if you need to express it as a percentage, so what you need to do, you need to take the change, which is here for cash, it's minus 3,000, and then you need to divide it by 13's number, which is 32,000. That means minus 3,000 divided by 32,000, you will find minus 9.4%. That means your cash actually decreased by 9.4%. And you could do the same thing for every item of your balance sheet. In this slide, you see all those asset numbers, and here in this slide, you see liabilities and stockholders' equity numbers. And this is how you could do a comparative balance sheet analysis, and this is another type of horizontal analysis. Now you could express horizontal analysis as a trend. So trend is just kind of all those years you are expressing one to next to one another, and you are just showing an overall trend for all these years. So definitely we'll consider one as a base year. That means in this figure we are considering 2006 as a base year, which is our 100%, and then we can express all other future years, and we can express as a percentage, and we can say that what percentage we actually increased compared to 2016, and you can also see a pattern trend. If you see all upwards, that means you are consistently increasing. If you see downward or different type of pattern, then you can also measure the performance across the years by watching these trends. Now here what we just did, we actually express everything as a percentage of a base year. So 2009 is the base year. So if you consider only the sales number, 2009 sales is 600,000. Now for every year we are expressing as a percentage of 2009. So that means 2010 18,000 divided by 2009 sales, which is 600,000, you will find this number 103%. Or for example, 2013 your sales is 803,000 and your base year is 600,000. So if you divide 803,000 over 600,000, you will find the percentage change 134%. So if you consider 2009 as 100%, so 2013's number is actually 134%. In another word, you can say in 13 your sales revenue actually increased 34% compared to 2009's number. So this is how you could do your trend analysis. Now we will learn about the vertical analysis. So for vertical analysis, it's actually you are comparing everything for 1 year, and you are comparing all numbers vertically, and you should have one base number. And for the income statement analysis, your base number is basically your sales, and for the balance sheet analysis, your base number is the total assets. So for your income statement analysis, you are expressing all numbers as a percentage of sales. So you see this is your income statement, and if you consider sales is 100%, then you can take every number, for example cost of goods sold, which is 513, and you can divide it by 858, which is your sales revenue, and you can express it as a percentage of sales. So here cost of goods sold is 59.8% of your sales, and this is how you can do your vertical analysis. I'm repeating, for your income statement analysis, you're gonna express everything as a percentage of sales, and for your balance sheet analysis, you're gonna express everything as a percentage of your total assets. Say for example, this is the vertical analysis for your balance sheet, and these are the assets on your asset side. So you're gonna express every asset item as a percentage of your total assets. And again, here for liabilities and stockholders equity, you're gonna express everything as a percentage of your total assets. And of course, you know from your financial accounting class, total assets must be equal to your total liabilities and stockholders equity. So this is your 100%, which is 787,000, which is exactly like your total assets, 787,000. Now you're gonna express every item as a percentage of this total amount. So that means, for example, for accounts payable, 73,000 divided by 787,000, which means that accounts payable is 9.3% of your total liabilities and stockholders equity. Now we will do one common size financial statements. So the common size financial statements are actually one type of vertical analysis, and you can compare with your performance to other competitors or industry average performance. So here you see for your income statement, you don't have these dollar values. You have all these vertical analysis and everything is expressed as a percentage of your sales. Now if you are the supermart, then you can compare the same type of vertical analysis with your competitor. For example, your competitor is Target. So now you can compare every number. For example, your gross profit is 40% of your sales, and your competitor Target's gross profit is 30.6% of their sales. So this is another way you can compare your own performance against the industry average or against your key competitors. But here you are just comparing with the percentage figures, not the dollar values. And this is called your common size statements. Now we will learn the most important item for this chapter, which is the ratio analysis. So for ratio analysis, you are expressing everything in terms of a ratio, and you are comparing your own ratio against your competitor's ratio and against the industry average. So this ratio analysis is really very common to evaluate the performance of any company. So we're gonna learn different type of ratios. So if you check your formula sheet, I have different boxes, and each box actually explains different type of ratios. First, you will learn the ratio that actually helps you to evaluate your performance to pay your current obligations and current liabilities. And one of the most important ratio is the current ratio, and how you could express this current ratio. So the formula is that current ratio is equal to current assets over current liabilities, and you will have all these numbers. So I will give you the whole financial statements, that means an income statement and a balance sheet, and you need to take all these numbers and you need to express those as ratios. And I will also ask you calculate these ratios. So to calculate the current ratio, you need to know the current assets and current liabilities. So the ratio is current asset over current liabilities, and Supermart's 2 years figures are there. This is the example I took it from the textbook. Now you can compare those ratios. So in 13 their ratio was 1.87, but in 14 the current ratio is 1.85. Current ratio decreased slightly from 13 to 14. Now what should be an ideal current ratio? Usually they say that the current ratio should be more than 1. That means you have enough current assets, which usually include cash, accounts receivables, inventories, these type of current assets, that you have enough current assets to meet up your current obligations or current liabilities. But if your current ratio is less than 1, which implies that your current asset portion or the top part is actually lower than your bottom part, which is really very risky. From a financial risk point of view, it is bad for a company. So current ratio, if it is more than 1, which is good, and usually it says 1 to 2 is good, but if your current ratio is more than 2, 3, 4, that means you have too high current ratio. That means you have too much current assets. Sometimes it's also bad because you are just holding too much current assets, such as cash or inventories, and it's kind of, you have to pay the opportunity cost of holding all those assets ideally. Now the next ratio is another ratio to check how you are capable, how much you are capable to pay your current liabilities, and this is called the acid test ratio, and another name is the quick ratio. So this is actually based on the current ratio, but instead of taking all current assets as your numerator, you are taking very pure current assets, which are cash, short-term investments, and net receivables. So usually for your current asset you may have marketable securities, but here you are not considering that. You are just taking very pure, very quick assets or current assets. These are also known as quick assets, very liquid: cash, short-term investments, and net receivables. So you have to take the total of these three items, then you have to divide it by current liabilities. So if you compare Supermart's 13 to 14's current acid test or quick ratio, you will see that actually increased, which is good for this company. Now another ratio that actually tells you your ability to sell inventory, which is called the inventory turnover ratio. So it actually explains how many times a year the company can sell its average level of inventory. And remember, higher the ratio, it's better for the company. So now how you can calculate the inventory turnover ratio? The formula is that cost of goods sold over average inventory. So cost of goods sold, remember, is an income statement item. You will get this number from the income statement, but inventory is a balance sheet item. You need to look at your balance sheet to know what is your inventory. So if you see any ratio which is a combination of one income statement item and one balance sheet item, for the balance sheet item you need to take the average of your current years and your past years numbers. That means here, if you need to calculate the average inventory, it will be the beginning inventory plus the ending inventory divided by 2. So beginning inventory actually means your past year's inventory, and ending inventory means your current year's inventory. So to calculate the inventory turnover for Supermart, and we are calculating 2014's inventory turnover, we will take 2013's inventory, then we will add 2014's inventory, and then we'll divide it by 2. So now here your denominator is giving you the average inventory. So remember, I'm repeating, if you see that for any ratio you have the combination of one income statement item and one balance sheet item, for the balance sheet item you need to take the average. So if you take the average inventory like this way, average means past years and the current year's average, then you found that the inventory turnover ratio is 4.6. You also need to know how to interpret this ratio. That means on an average, they actually sell their whole level of inventory 4.6 times, right? And higher the ratio, it's better for the company. Now another ratio also tells you about the ability to sell inventory, which is called the account receivables turnover. That means how quickly you actually collect cash from your customers. That means if you make any credit sales, it creates an account receivables, and you also need to know how quickly you can collect cash from those credit sales. And again, higher the ratio, it's better for the company. So the formula is that net credit sales divided by average net account receivables. Sometimes you will see that net credit sales is not given. You are given only the sales. So if you really don't know what is your credit sales, then just take the sales number. And for net account receivables, again, sales is from your income statement and account receivables is from your balance sheet. So for the balance sheet item, you will take the average. So again, the bottom part is the average net account receivables. That means your beginning receivables plus ending receivables divided by 2, which means your past year's receivables plus current year's receivables divided by 2. And this is how you will get the average receivables, and the top part of the numerator is the current year's credit sales, and this is how you get that the average and the account receivable turnover is 8.6. Again, higher the turnover, it's better for the company. Now you have a couple more formulas. It says days sales in receivables, so it's same thing, how quickly the company actually collects their receivables, but now you are expressing in terms of days. So first you need to calculate what is your 1 day sales. So usually you will be given an income statement which says your total sales for the year. So if you know your total sales or net sales, then you can divide it by 365, and this is how you will get your 1 day's sales. And in 2014's examples, their net sales is 585,000, and if you divide it by 365, you will get your 1 day sales. Now to calculate the day's sales in average account receivables, your top part or the numerator will be average net account receivables, and your bottom part will be your 1 day sales. So again, the average receivables, you need to take the current year's receivables plus your past years and then divide by 2, and then you're going to divide the whole thing by 1 day sales, which you found here. And this is how you calculate your day sales receivables. So that means here the results is in days, 42 days. So on an average, the company takes 42 days to collect their credit sales from their customers. But remember, for this ratio, actually it's lower is the better, right? So if it takes a long time to collect cash from your customers, it's bad for you. So you will, if you need to compare your ratio, day sales in average account receivables, from your ratio to your competitors, you will always remember that lower is the better. And now we will learn few other ratios, and these ratios actually evaluate your performance to pay your long-term obligations or long-term debt. One of the most important ratio is the debt ratio, and the formula is really straightforward. Debt ratio means total liabilities over total assets, and everything will be given here. So you just need to take your total liability over total assets, and you check here that from 13 to 14, if you plug in the numbers, their debt ratio actually increased. In 13 it was 0.5, now it is 0.55. And again, for this debt ratio, higher is actually not good, lower is the better. So for all those ratio analysis, you need to know which one is good for you, whether the higher is good or the lower is good. Here for debt ratio, higher debt ratio means you have high debt, which actually implies some financial risk for the company. So lower debt ratio is actually better for the company. Now, what should be an ideal debt ratio? Again, there is no fixed numbers. For some companies, for some industries, debt ratio could be like 0.8, 0.9, but for some industry, debt ratio could be very low, like 0.2 or 0.3. So it depends on your industry and your competitors. So what amount of debt ratio, what percentage of debt ratio is good for you. But you have to remember, lower is the better when you're gonna explain your debt ratio. Another item is time interest earned ratio, or we also call it interest coverage ratio, and it says how many times your operating income actually covers your income statement. And if you check TIE ratio, in short we call it TIE, times interest earned, TIE ratio, and the formula is income from operation divided by interest expense. So you see here, the top part is your income from operation and the bottom part is your interest expense. So income from operation is actually covering your interest expense. So in another sense, you are kind of justifying or evaluating that how capable you are to cover your interest expense by using your income from operation. And again, here higher is the better for your company. And if you plug in the numbers, you found that from 13 to 14 their TIE ratio is actually increased, which is good. Remember, if your TIE ratio is less than 1, this is very risky. That means you are not able to pay your interest expense from your income from operation, which means that the company may be bankrupt and may not be able to pay their interest expense. So this actually implies very high financial risk. Now, next bunch of ratios are talking about your profitability. So these ratios actually compare or measure the profitability of a company. Number one ratio is return on sales, or in short we will call it ROS, rate of return on sales, or simply return on sales, or ROS. The ratio is really straightforward. Net income over sales. Return usually it implies net income on sales. So your bottom part is your sales. So the ratio formula is net income over sales. If you plug in the numbers, you see that in 13 it was 3.2 and in 14 it's 5.6. So your return on sales actually increased from 13 to 14. Now another profitability ratio is called ROA, or return on assets. Rate of return on assets, or you can just call it return on assets, or ROA. So the formula is the top part of the numerator is net income plus interest expense, and the bottom part is the average total assets. Again, if you see for any ratio formula, it is a combination of an income statements and balance sheet items. Then for the balance sheet item, take the average. So return on assets, or ROA, the formula, the numerator should be net income plus interest expense. You are adding back your interest. That means what would be your net income if you don't have any debt or if you don't need to pay any interest. And then you're going to divide it by the average total assets. How could you get the average total assets? You have to take the past year's assets plus current year's assets, and then you have to divide it by 2. This is how you can get the average assets, or you can get any type of your balance sheet items. And I will give you 2 years balance sheets, and when we're gonna practice some problems, you will see that every time you'll be given both years balance sheet, because for some balance sheet items you need to take the average. You really need to know both years balance sheet numbers. So if you calculate this ROA, you found that the ROA is 9.5%. So how to interpret this ratio? It means that if you have $100 assets, on an average you will make a return $9.5. So again, higher is the better for a company. Now the next ratio is ROE. In a full term, you can call it rate of return on common stockholders' equity, or in a short, you can call it ROE, return on equity. So the formula is here net income minus preferred dividend, and then divided by common stockholders' equity. Again, whenever you will see any return, ROA, ROE, ROS, return means your net income, and then return is based on what? Here ROE, the return we are measuring based on the equity, so your bottom part will be the equity. And since we have one income statement and one balance sheet item, for the balance sheet item we have to take the average. So now we are actually taking out the preferred dividend. If you remember from your financial accounting or other finance course, there are 2 types of stockholders. One is called the common stockholders, another is called the preferred stockholders. So here from your net income we are taking out the preferred dividend. That means the rest of your net income can be claimed by the common stockholders. So if you see any preferred dividend number is given, you will take it out from your net income to get the top part. But most of the cases you will see that there is no preferred dividend information, so you will assume the preferred dividend is a 0. And then for the bottom part, or for your denominator, you will take the average of your stockholders' equity. So again, for average, past year's equity plus the current year's equity divide by 2. So your ROE for 2014 is 14.2%. That means if you have $100 stockholders equity, then on an average you will make a return which is $14.20. And again, higher is the better. Remember, for the debt ratio, higher is actually not good, and day sales in receivables, higher is actually not good. Other than that, most of other ratios, higher is the better. Now another profitability ratio is EPS, or earning per shares. So these EPS, or earning per share, is only for the common stockholders. So again, if anything is for the common stockholders, you will take out the preferred dividend. So we need to know what earnings should go to the common stockholders. So whatever the total net income, you will subtract your preferred dividend, and then you have to divide it by number of shares outstanding. It is called earnings per share of common stocks. Earnings means net income, and this earning is only for the common stockholders, so you will take out your preferred dividend, and this is say earnings per share. So you need to divide it by the number of shares outstanding. Again, the number of shares will be given. And if you compare here from 13 to 14, their EPS actually increased. Earnings per shares, in short we'll also call it EPS. EPS actually increased. That means for every share they will have in 14 around $4.8 earnings, and of course higher is the better. So EPS is another important profitability measure ratios. And our final ratio is PE ratio, or price earning ratio. So here you are actually expressing your market price per share against the earnings per share. So market price per shares means that at what price your current shares are traded now in the market. So this will be given what is the market price per share, then you have to divide it by earnings per shares. Again, higher is the better. So these are all ratios. I know it's a little bit difficult to memorize all the formulas, but I would suggest either you can make flashcards, or you can write down the formula several times. Then you will be able to know all these formulas, or you can follow some tips that I just explained to know all these formulas. So that's it from chapter 4.